Is my screen seen?
Yes, Taha, we can
Okay.
perfectly see your screen.
All right, very good. So today we are discussing the asset financing for commercial and industrial across Africa. So basically, it's East Africa, but this could go for all the African continent. Um, so this is just an idea about what we are going to cover today. The growing role of C&I solar in Africa, why rising energy costs are accelerating adoption across the countries, the asset financing models, different asset financing models. We are going to talk about the leasing model, about power purchase agreement, which is known as PPA, debt financing, and blended finance as well. We are also going to learn and share experience about a very important point, which is how banks and investors evaluate your deals and your projects, what the lenders are looking for on, and how C&I solar projects get structured. We are also going to share some case studies and lessons learned for real examples on commercial industrial solar financings in action across Africa. And also, we are going to talk about how is the starting of your solar transition, the practical first steps for factories, hotels, hospitals, and shopping centers, any high consumer of electricity. What are the first steps towards solar transition? Just in a small statistics, we're going to share why commercial and industrial and why now. Just to speak about it freely without the presentation, in East Africa, talking about Tanzania, Kenya, even Uganda and Zambia, the tariff of electricity is not very high compared to other parts of the world. So residential is not that strong market to be financed at the moment. That's why we are talking C&I and now. To give you some numbers, from 2024 to 2025, as installations grew year on year, the growth is 54%, and that's the fastest pace on record. Cost per kilowatt hour is 0.08 to 0.20% on solar, if you use solar, while it's 38 USD cents per kilowatt hour if you are using diesel generator. Up to 40% is the industrial operation share as OPEX for factories and other institutions. Grid instantly is unstable, and the rising tariffs across the East Africa region, they're pushing commercial and industrial businesses to treat solar as a financial hedge, not just as a sustainability initiative. In South Africa, Kenya, Nigeria, Ghana, and Tanzania, we are all seeing rapid C&I uptake, but access to financing remains the deciding factor in how fast that adoption scales. That's why it's very important to tackle the topic of financing, where to get financing for our solar projects. We all know financing is the biggest barrier. Solar's economics already beat the grid and diesel in most markets. So it's very clear, 1 + 1 = 2. If you use solar, it's cheaper than using the grid. It's cheaper than using diesel generator. Everybody knows that. Nobody is waiting for a proof. But the businesses, they rarely have the capital or the credit profile and the risk appetite to fund a system outright. High upfront capital cost. To have a solar system for your factory, it's not a cheap thing. It's an expensive capital to own and to own the system from day one. Also, there is limited access to affordable debt. Long tenor, single-digit interest financing is scarce for mid-sized commercial borrowers. Perceived project risks. Lenders and insurers often lack a track record for underwriting C&I solar and in these markets. So now we introduce the asset financing, which changes the equation. Instead of a capital expense, solar becomes an operating expense, paid for from the energy savings it generates, with little or no money as a down payment. To speak it in our language, if your factory is spending 100 million X, whatever your currency is, and you install the solar system as an asset finance, if you are saving, let's say, 40 million from your electricity bill of 100 million, the payment you will do for your asset financing project is less than the savings. So also you will be saving real money, not only emissions and fighting the climate change and all this. We have 4 ways to finance C&I solar in Africa, and I guess all across the planet. You have the first one, which is leasing, where you pay a fixed rental to use the solar equipment with no upfront capital outlay and predictable monthly costs. So it's just leasing. Then we have the power purchase agreement, the PPA, known as PPA. Now, PPA doesn't work in all countries in Africa. Some countries you are not allowed to do PPA with off-takers. You have to do the PPA with the government or the power distributor company. In the power purchase agreement, a developer owns and operates the system. You simply buy the power it produces at a fixed rate. It's always lower than the tariffs of the grid. Then we have the debt financing, where factories can borrow to purchase and own the asset outright, repaying the loan from the energy cost savings it generates. As I explained earlier, always the monthly payment has to be less than the amount we are saving on our electricity bill. In this case, it's just like taking any normal loan to extend your production or whatsoever. And then we have the blended finance, which is a concessional and commercial capital combined to de-risk projects and unlock lower cost financing. So it's a combination between leasing and debt financing together. This is a very important point, how banks and investors structure commercial and industrial deals. So first to look at is off-taker credit worthiness, the financial strength and payment history of the business consuming the power. So keeping our books, guys, this is very important. We face this challenge with many companies in Africa, where these companies, they don't keep the real records of their books. They don't keep real records of their power consumption. So the real consumption and the consumption on papers is not the same. So for the banks and investors, this doesn't make any sense. Also, same in the books for everything else in your company, you have to keep your real records. Leverage ratio and the cost of debt. Financiers typically target 70% plus debt leverage at single-digit interest rates to keep tariffs below roughly 10 USD cents per kilowatt hour. And then we have the contract structure and security. There is the escrow arrangements, where let's say there are 10 mining companies or 10 miners in one area, and you want to build the solar plant to power these mines. So there will be an escrow account with the bank that's financing, where these off-takers will be paying to the escrow account, and the bank will know where the money has to go, what amount will go to the developer, what amount will go to other parts. Then you have the guarantees and the step-in rights that protect repayment if something goes wrong. This usually is requested when the client is the grid itself, and not off-taker. and it's usually asking for government payment guarantee to secure the payment in case of any defaults. And then you have the EPC and O&M track record. Banks always wants to make sure that the EPC company and the operating and maintenance contract is in place, and the EPC company has the experience in performance over the contract term. So this basically what banks, investors, and lenders are looking for to finance projects in the C&I world. I'm sharing just a couple of case studies in the presentation. Then Mr. Mussa can talk more about others in the discussion. First, on the left, it's a 500 kilowatt peak solar installation, helping a factory in Dar es Salaam to cut their daily energy consumption from the grid by 35%, generating 700 megawatt hour of clean power annually by shifting a significant share of its load from grid electricity at 0.07 cents to solar at just 0.02 cents. So that's 2 cents per kilowatt hour. The client has reduced its overall energy bill by 25%. So again, we were talking about 100 million. So if you consider this was paying 100 million, so they reduced by 25 million. Now they're paying 75, and their bank payment, their monthly payment is less than that. So they have savings already. And their payback period is under 4 years. Now, with the interest of the bank, it gets to 4.5 years. That's all. Then the loan has been redeemed, and the system will work for the rest of its lifetime, which is usually from 15 to 25 years. The other option is 900 kilowatt peak with the PPA model. Now, in this case, there was a limited roof. So the roof was not all strong enough to be used for solar panels, but the amount of roof we were able to use has managed to accommodate 900 kilowatt peak solar system. It's been there for 1 year. It produced 1.9 gigawatt hour the last year, offsetting 11% of the factory's electricity bill under a blended tariff power purchase agreement. So we have a power purchase agreement with this factory, and it's a blended tariff power purchase agreement. Combining generator and grid electricity, the client pays fixed rate over a 10-year tenor. So after the 10-year, the client will stop paying and will enjoy the system for free for the rest of its lifetime. And they paid zero upfront investment. In this case, they haven't invested anything. So no CapEx, it's only OpEx. And they have already saved approximately $21,000 in cash. So they paid the electricity bill, they paid the power purchase agreement, and still they managed to save $21,000 in 1 year. Now we are in discussion with this factory. They started enforcing their roof to double the system. It will be 1.8 megawatts. So also their saving will be double. Also the net saving will be 42,000 instead of 21,000. We're talking about steps to begin your solar transition. If you are a high consumer, factory, hotel, hospital, shopping center, or anything that consumes a lot of electricity, how to start, what are the steps to begin your solar transition? First one is energy audit. We have to access the load profile for consumption. We have to know in details, and we have to analyze the consumption map of this factory or premises. Then from here, we can start designing a system to serve the purpose. After that, we go to choose a model of financing, match leasing, PPA, debt, all the other models we spoke about. Then you need to select an EPC partner. If you are investing from your own pocket, you have the privilege of choosing any EPC partner you find it's convenient for you. But when you are working with a developer or a bank, it has to be a trusted company. And the EPC partner has to be a trusted company. And they have to be able to provide the services that you need. So because the performance of the system matters in asset financing. It's the most important part. Then we go to the installation and commissioning to build and bring the system online. Always the systems that has to be financed, it has to be monitored online. All the parties has to have access to monitor the system and see how is the power generation, how is the saving going on, and also the monitor and maintain. Now, usually, what is happening at the moment is that the EPC company is the operating and maintenance. This is what all the financiers they prefer, because then you can have double guarantee on the performance of your system. Just to give you a brief about our company before we move on. So we are AG Energies. It's a company was established in Tanzania in 2015, and we have extended our presence to Kenya, Uganda, Zambia, and Rwanda. We have offices and we have projects as well. We do EPC, so we do from designing to execution of projects, solar projects. We do also distribution of solar products for other resellers, other installers. That this part includes trainings, awareness. Also, we do the energy solution. We do energy audit and other services. Also, we are working on e-mobility projects. We have our own EVs that we assemble and manufacture in Tanzania, 2 and 3 wheelers with business with battery swapping business model. And we also work on the charging infrastructure for EVs. This is something we are working with the government of Tanzania for sure. My name is Ahmad Taha, and I'm the Chief Marketing Officer of AG Energies. I am with Mr. Ibrahim Mussa today. He's our Chief Operating Officer and co-founder of the company. And I hope the presentation was not boring, and I hope we will have a very productive webinar. Thank you, Salim. Thank you, AFSIA. And thank you, everyone. Here you go. For you, Salim.
Thank you very much, Taha. The presentation was very amazing. The point that I already have a ton of questions, and I hope Ibrahim Mussa is ready for them. And at the same time, just to let you know, we are also live on our digital platform. We are also receiving questions from LinkedIn. So this means your presentation was very amazing, and it can be reflected from the question that you are receiving and interest of people. So I'm going to start with some question that I got from the audience. I will pick the first one from Amin Lakani. Amin Lakani is asking if we can please explain the leverage ratio and the cost of debt in details, preferably with an example.
Okay. Thank you, everyone. My name is Ibrahim Mussa, Chief Operation Officer. Salim, can you hear me?
We can hear you perfectly.
Okay, thank you. Yes, yes, to answer that question, normally about the banks, when it comes to debt coverage ratio, it's depend from bank to banks, but actually they do the ratio is 1.3. This is what it's the best debt coverage ratio. What does it mean? It means your payment need to cover 1.3 times the payment you need to do to the lender, who is the bank. So yes, so if you owe 10,000, you should at least get 30,000. Yes, think so because they know that sometimes there are delays in payment and everything. So by having that healthy coverage ratio, you will be able to pay even if the client has a small delay in terms of payment. And then when it comes to interest, so interest varies from country to countries. And then there is a big challenge which is happening is, most of regulator and central banks, Nowadays, they don't allow, like the new law in Tanzania, they are not, you are not allowed to trade in foreign currencies when you are operating locally. Let's say company A is charged company B. You are not allowed. Both companies operating in Tanzania, you are not allowed to charge in foreign currencies. So this comes with a problem because when you are charging, when your incomes are in, let's say in shillings or in any local currencies, that means when you go to borrow money, you have to borrow money in the local currencies. And then the problem with local currencies, it's very, very rare to get a single digit loan. So you are playing around 15 up to 18. In other countries can go up to 25%. And then these are sometimes the things which kills the deal when it comes to a solar project. But if your country allows to borrow in dollars and also get your income in dollars, some places you get 8%, maximum 12%. So you can easily get a single digit interest rate. Yes.
Perfect, Musa. This is very interesting. And coming back a little bit to the content of this webinar, whereby depending mainly about the narrative, because I know back in the days we used to speak about solar. We used to see solar as an alternative source of energy because the grid was unstable. The grid was unstable, and businesses couldn't rely on the grid anymore. So is it the same thing that is happening right now, or now businesses, they are really leveraging solar for different reasons? For example, for reducing the costs, for example. And it's not more only about we will not rely to the grid anymore, but now we can use solar to reduce the cost. So this is one point that I'm raising, but are there any other reason that is driving a company to invest into solar?
Yes, I can give you, we have a typical case. Okay, we didn't close yet, but we are still negotiating. It's a steel factory. So the industry is very, very competitive. And one of the strategy that factory can reduce their running cost in terms of electricity, because like a steel factory, they use a lot of electricity, and this can be a competitive advantage in the market to be able to offer their product at a very competitive price. So it's not only about the stability of the system or the power. No, it's also sometimes a business strategy. So yes, so this is a typical case. Someone wants just to reduce the cost of electricity to be able to be more competitive in the market. Yes.
This is a very good example that even myself, yeah, Taha, you can jump in.
Yes. Also, there is the unmeasurable impact, which we always keep it aside. You have the marketing impact. Companies now are using the solar not only to reduce their consumption or their electricity bill or their cost, also it's a marketing aspect. You can find now many big companies around the world, they are promoting that they use solar because it means something, despite the carbon credit topic, because people will be generating money out of this carbon credit later on. So you have the marketing aspect, you have the carbon credit, and you have your share of the fighting the climate change. So these also are important for some companies. Yeah.
Very good points, Taha, to also mention the impacts that this adoption is bringing to the ecosystem. So we have a question from Laurent Messina from France. Laurent is working from Energy Pool in France and is asking, what is the performance you recommend? Offer, availability, genset operating time.
I didn't get the question.
Is the question clear? The performance
can you
is
repeat,
asking, Laurent
yes.
is representing Energy Put from France. Is asking what is the performance that you recommend? Offer, availability, or genset operating time?
Okay, so it depends. You know, most of CNI, especially in our region, they are not now using more on the VSS. That means the batteries. So most of them now, the big majority are using the grid connected. So by having a grid connected system, you are not avoiding the generator, but you are reducing the generator consumption, because for the solar to work, you need you need a reference source. So either it's a grid or the generator. So for a grid tie, you the most important is to have the system which will work just below your maximum consumption, to avoid wasting energy. And especially we don't have, let's say in our region, Kenya, Tanzania, Uganda, and Rwanda, we don't have net metering, so you cannot export excess power. So you need to have just a bit below your peak consumption to avoid wasting a single kilowatt hour when you invest in solar. And also the generator, when it is running, it is also running maybe at 30% of its 30% of the consumption, which you will be able to reduce maybe 50% of your daytime generator consumption, which is a considerable amount of energy and also money that you are saving.
Okay, and we also have some question on LinkedIn. I'm going to pick one question from LinkedIn right now. The question is asking why agriculture is not considered in your presentation, because apparently the agriculture market is also a big market, and how to work with your reseller. I don't know if this question makes sense to you.
Okay,
I think,
you know, okay, please
go.
go.
I felt, you know, attacked because I did the presentation.
Yeah.
Actually, yeah, thank you for bringing this up. You know, agriculture, we are not
sorry, if you can allow, the name is Félicien Iyamuremi.
Yes, Félicien. Yes, Félicien. So first, thank you for bringing this up. Actually, you know, we always say we do residential, agricultural, commercial, industrial, and utility scale. This is how we introduce ourselves as an EPC company. In this webinar, because we are talking about commercial and industrial asset financing, we considered any agriculture project with high consumption of electricity is also commercial and industrial in terms of system size. But yeah, it would have been better if we mentioned agricultural in bold. But yeah, we do this also for agriculture, for water pumping basically, and for irrigation as well. Also, we have some projects in the pipeline where we are looking to find the developers who are interested in other parts of electrical equipment for the agriculture world, like dryers and freezers and other things. Yeah, so it's considered.
Okay, because Felicia also asked how to work with you, and he also asked if you have office in Rwanda, and I guess you have office in Rwanda, and probably after this meeting, we will see how we can maybe put you in touch with Felicia.
Okay, so regarding our existing in Rwanda, we exist in Rwanda. We have projects in Rwanda. The office is not yet open, but we do frequent visits to Rwanda. We have some big clients as well there. So I guess beginning of 2027, we will be represented there by an office. There was another question, how to what?
How to work with your reseller.
Yes, okay.
Maybe because I know that you are also a distributor, so probably wanted to understand how to work with you.
Yes. So, however he like to contact us, we're available in this chat. We're available on LinkedIn. Also, we can. I will just share in the chat my email and Mr. Musa's email as well. I will write them now in the chat. Anyone who wants to contact us, feel free.
All right, perfect. So I'm going to take the next question from Aymeric Kwam. He's asking, at what stage of the project's life cycle are the financier willing to take exposure? Is it at the contract signature, at the notice to proceed, at the commissioning, or only once the asset has an operating track record? And if it is post-commissioning, what will they need to see in the pre-completion phase to be comfortable taking out a bridge financier at that point?
Okay, to answer that, it's a very good question and then a precise question. So normally it's depend. It depend. I didn't get the name, but his company.
The name is Kwam.
Yes,
Kwam.
Kwam, maybe he's representing a company. So
Yes.
them as a company, if they are a developer, first of all, as a developer, when you get to finance a project as a developer to run it and put it on your books, first of all, the bank needs your exposure. That means skin in the game. That's why when they're financing a project, they finance it at a level of maybe 70 to 80%. They are not financing 100% because they need you to commit and also to put some financing to be able to feel the pressure and also and do a good job. So if you are a developer, they are willing to take a risk immediately when you are starting to bring project after the signature, of course, of the contract, because that's why you see most of people, they go by getting the contract first and then go to do the financial closure at the second stage, because you cannot have finance if you don't have a contract in hand. So it's very difficult for a financial to evaluate a non-existing contract, because they need a contract. That contract is very important. They want to know the terms of the contract, what are the payment terms, how do you plan to do the O&M, all these aspects, the legal part of it, and also the insurance involved, because they want to be the first beneficiary when there is anything claimed to the insurance. So all these parts need to be included in the contract. So you need to secure the contract first, and then you go to the financial. But you cannot start to see them after you get the contract. You need to initiate first the contact and everything. When you establish the connection with the financial, and then from there you will give them the pipeline, and then they will start to really analyze the case when you have already secured the contract. Yes. I think was another question, the second question.
The second question, and if it's the post-commissioning, what will they need to see in the pre-completion phase to be comfortable taking out the bridge financiers at that point?
Okay, there it's I've never come across financials coming in after you have you have commissions, unless you are an energy producer. And then when you are an energy producer and then selling out your just come investors, they're buying maybe shares in your company. This is normal, like you are an energy producer and then you have your SPV and then it has a couple of projects inside. And then it's like any other business, and then you just go and then share, and then like equity investors, they will come and invest in your company because they have seen that you have a good track, and also you have a track record of your income, and then they see also that if they put their money, they will get some return on investment. So this is happen when you have equity investors. Yes, when you have equity investors, Of course, they want to see the track record after the commissioning. But when you go for financials like banks, I think they need to be on board on the beginning, and also when you are selecting an EPC company, when you are selecting the OEM, the supplier, the suppliers of inverters and batteries and all those involved equipment in the system. Yes.
Perfect. We still have 8 minutes remaining, but if Taha and Mussa allow me, I will extend the time because the questions are very interesting and the conversation is very good. I'm taking a question from Dawi. Dawi works from a company called Pramac Generac Group. And Dawi de Villiers is asking, do you find in your region that customers are looking for higher quality internationally backed C&I products at the expense of a higher price, or is the conversation purely financial based with the focus on the fastest return? We are seeing an influx of lower quality products, but this comes at the expense of longevity, typically.
Okay, this is mostly on small size CNI. This is where we are talking about prices only, and also residential, because it's mostly for residential. It's people are not really counting. They are not counting the payback period, things like those, because they want just to be comfortable, to get power, and to be able to allow the family to be comfortable. But when it comes to CNI, it's solar is a commodity that now electricity is the core of any factory. If you don't have or any big company, so if you don't have electricity, you cannot operate. So that's why it will be really difficult finding someone want to go for a lower quality product while investing the money. So, of course, there is a conversation about the price. And so this is where you see, because of the competition, you see the EPC company also squeeze their margins, but they will still offer a good quality product. And then when you add a layer of an investor, then you have an investor coming into the game. They cannot relate going with a product which is not qualified, because most of the time you find that those financials, they have a list of product that they accept to finance, and also they have a list of EPC company that they want to work with, because it's very important. All this starts from design, product selection. When you have for example, you have a PPA, and then PPA is 25 years. Your system design life should be 25 to 30 years. And then you should have a product which comes with a warranty, which minimum 15 years when it comes to inverters and battery and panels and things like those. So it's very, very important to have a good quality. Yes, so the price, of course, plays a big role, but the best product also it's crucial for investors and also financials. Yes.
This is very interesting, Mussa, and I also listened to your presentation, and I would also like to ask a question, because I also have a question. So the presentation highlighted energy operation in Tanzania, Zanzibar, Kenya, Uganda, Zambia, and Rwanda. And with your expertise in EPC, C&I, solar product, and e-mobility, I have two questions. One about the company itself, and one about the case study that you presented. So coming back to the first question, due to your operation in different African countries, especially in East Africa, what differences do you observe between these markets? My second question is regarding the case study that you presented, including a Tanzania project financed through a debt and PPA. What lesson from this case study can business here listening to us apply to their own projects? And if you could do this project again, what would you change?
Okay, answering your first question. Okay, operating in multiple countries, it comes with its own challenges. And For us, it is okay because we are operating in East Africa. And apart from small differences, but the core and many, let's say, importation taxation and importation law are almost the same because it's decided on the regional level, the East African community, when it comes to import duty, exemption, and things like those. Also, you have like the VAT, which are deferred. Let's say Tanzania it's 18%, Kenya it's 16%. You find Rwanda 18%, things like those. But the challenges that we are finding is the law. For example, in Tanzania, it's very difficult to do a PPA per se for a CNI. So that's why people use the lease because of the law. But you find like in Kenya, it's you can do PPA. So those are also the problems that we encounter when you operate in multiple countries. And also the level of exposure. For example, you find some markets are more developed than others, and you find that you have more projects in some countries, but which comes also with because it's a developed market. You find also there is a challenge in terms of competition. You really need to crack your head to be able to onboard client, also to do project, and you have less developed market, which comes with the challenge. You have a gap of knowledge. Clients are not willing to engage. And also when it comes to the financing, because we prefer to deal with the local financing so that we will be able to tackle problems of client incomes, payment in local currencies. So we find that the rate varies between countries, the loan rate between market, yes. So those are the challenges that happen when you operate in multiple countries. And also, when it comes to the case study, first of all, the client that is on PPA, which we call it a lease to own model. If we were to redo it, wouldn't spend more time trying to sell him a PPA while it was not possible. It was very difficult to do it in a Tanzania market. So it took some time to be able to come up with the best solution for the client, where you have to meet the demand of the law, the demand of the bank, and also the need of the client. So if we have to redo it, we'll go straight to what we have now. And also, we did not also manage to. We were thinking also of seeing how it's a possibility of financing also the roof fixing, which also is an option. We just discovered that it's an option also which can be given to the client, where we could offer him 1.8 megawatts straight away instead of starting with 900 because of the problem of the availability of the roof. Yes, thank you.
Perfect, Taha. As planned, we are leading toward the end of the presentation. It was very amazing. Unless, as I was saying, unless you allowed me to pick up some few questions, but the conversation was very interesting.
Please.
Do you allow me to proceed?
Yes, please.
Perfect.
Yes.
Perfect.
It's just once in a while. Yes.
Then let me pick, because we have very lot of questions here. So I'm going to pick a question from Amin Lakani. Amin Lakani is asking, if it's a pure on-grid system, the system is heavily dependent on the quality of electricity. How do you factor that in your financial model?
Okay. Normally, how that means when we do our financial model, we check the performance ratio of the system. So, for example, when you do a modeling on PVCs, you find that it is between 81 to 84% the performance. So when we do a power analysis on the system, when we connect the data login and also maybe for 2 weeks or 1 month while analyzing the power of the client. So we take into consideration the quality of power when we are giving a commitment on the performance ratio of the system. So, for example, you have a place where you will have maybe 4.2 kilowatt hour for every kilowatt peak installed. This is the daily average for, let's say, a place like Dar es Salaam. So in our place, we can consider, for example, a 3.6 because of the bad quality of power, 3.6 kilowatt hour per kilowatt peak installed. So we insert that number in our financial model, and then we run it. And then for us, this is the commitment that we give as a company when we are running our numbers and also showing to the financials. So this is how we do. And then also, for example, when you have maybe you need only if the problem comes after the meter. Let's say you have problems comes from the installation of the client. There is some advice that we can give to the client, and then the client just can correct to be able to do. For example, if the power is not well balanced, the load is not well balanced, we can propose to do the load balancing and other multiple solutions.
Perfect. And we also have another question here from, you did not mention the name, it's anonymous. How are EPC today dealing with balancing realistic EPC cost against HSE requirements, upgrades, cost of materials, and increasing cost of capital?
Okay. So it is very important when it comes to the cost of the cost of the system and also HSE. You know, now companies are really cautious when it comes to selecting an EPC. Most of companies, you know, they want to see your track record. How are your HSC? You have the track record of your HSC. Are you ISO certified or not, or things like those? So they really need to take care of that. And then when, for example, doing a tender, when it comes to doing a tender, I think they put also those HSC requirements. Really, if they are it is a client who really needs to do things in the proper way. And also, when you are financing a project, of course, the lender, the banks, they will need to see the HSC part from the EPC, and also not only the HSC, they need also an EPC who has financial muscles, because, for example, you need to give a performance guarantee after signing the contract in the range of 5 to 10%, and which will be running for which will be blocked for entire project execution time, maybe 1 or 2 years. It will depend on how big is the system. So I know most of some companies are not putting any emphasis on the HSC, but nowadays there is more awareness, and big factories and companies are coming from international background. They take serious the health and safety when you do any work. Yes. So now it's implemented a lot. Yes.
I'm enjoying now the conversation. I'm now learning many things. And because there is one important element that Taha really emphasized during his presentation was about what the bank looks for. He explained how lender assesses projects, including off-taker credit worthiness, leverage contract structure, and EPC track record. So how important is the financial health of the customer compared to the technology itself? And what role does EPC contractor play in giving confidence to investors?
Okay. So, the first thing that financial will look, of course, the founder of financial, like a bank, the credit team, will check of the credit worthiness of the off-taker. Of course, they want to see the track record. They want to see maybe 3 or 5 years of your books. So it is even before they go to check who is the owner, who is the supplier, what technology is used. The only thing that they are very good in because they need to protect the money of investors. The bank, they are not using their money; they are using other people's money to be able to finance those projects. So they are really cautious, and then they need to check first of all the credit worthiness of the off-taker. So, and then they are really good at it because this is their core business. So they have to check even before they go to assess the technology. So it's very, very important to have a good EBITDA. You need to your EBITDA need to be able to cover the repayment of the debt. So those are the numbers they check, and then they check maybe why they ask 3 to 5 years of your financials. They see maybe some companies are doing growth in terms of sales, but when it comes to profitability, the percentage keeps shrinking. So they need to check all these things to be able to see, yes, this company, at least the risk is minimal. Even if the soul you are paying from from the savings you are doing, you are making on the solar system, but they need to be sure. What if you are losing market share? What if you will be forced to reduce your production because of market share? That means your electricity consumption will drop, and also savings will be lost. Or there are a lot of things that they need to check. So the books matters more to the financials than the technology. I'm not saying that the technology doesn't matter, but the books comes first. Yes, and yes, after that, if the books are okay, then they come to the technology. And then the technology, it is okay. You have the big company, big bankable companies who has been there for the past 10, 15 years in the game. They have an amazing presence in the market to be able to give you support when it comes to the warranty. But the EPC is the most important. Yes, who is going to play with those tools? Who is going to play with those panels and inverters and the batteries? That guy knows how to calculate the losses of the cable, the length of the cable, to choose the right size of the cable, the right length, and things like those. So they really need to see who is the EPC, what the EPC has done. Salim, on every project, you have different challenge. In every project, you can do 100 projects, you will have 100 challenge. So they need to make sure that you can handle those problems, the pressure, you have the contingency, maybe delays in shipping. You have a lot of challenge in every project. So that's why the EPC also company plays an essential, a crucial role in approving the financing. Yes.
Perfect. And the last question, because we were talking about numbers, we were talking about finance, we were talking about how to give investor confidence. I hope Taha, Mussa, you will understand this question because it's very brief. Martin Kausil asked a very brief question. 0.8, 0.20 per kilowatt hour. please explain these figures.
Okay. Yes. For the
In
factory
USD, USD 0.8,
cents.
USD
Yes,
0.
yes.
So I did
This is
not
the
get.
tariff. This is the tariff. So this is the tariff. So they say that tariff varies from 0.08 kilowatt hour cents per kilowatt hour. So this is the cost of energy. For example, in Tanzania, it varies between you find that 0.069. This is the price of a kilowatt hour for high energy consumer. That's the tariff before the tax, before the VAT. So this is what you need to beat as when you are offering a solar solution. So 20, it's usually 0.20 cents per kilowatt hour. This usually when it comes for things like petrol station, homes. So these are the tariffs that they pay per kilowatt per kilowatt hour, because they are not a business. So let's say a petrol station, it's an exempted. It is they are not charging VAT. So for them, when they buy something with VAT, it is a cost for them. It's not like a factory maybe selling sodas. Of course, they will recover any expense they do in a VAT. For them, it's not an expense because they will be able to recover and pass it on to the end user, so or to the client. So this is the tariff, which varies from 0.8 to 28 cents to 20 cents per kilowatt hour, most of the time before tax. So this is it's only what it means.
Perfect. The conversation was very amazing, and now we are really hitting our timeline. And Musa, I really thank you for delivering, for being able to address questions from our audience, and Taha for delivering this amazing presentation. And I also want to thank our listener participant because they've managed to stay throughout the webinar for an hour, both on our different digital platform as well as here on Zoom. With this said, I'm going to thank you guys again, and I'm going to end this webinar now. Thank you once again for joining this webinar.
Thank you very much. Thank you. Sorry, Salim,
Yes,
there are
yes.
people asking to share the presentation.
Yes,
I
yes.
will, please, I think you have it. You can share it with them. I see everyone sending, yes. Thank you.
Yeah, so as mentioned during the housekeeping, we will definitely share the presentation and the recording after the webinar.
Okay, thank you very much.
Thank you very much.
Thank you. Bye.
Bye-bye.